If you're a senior or retiree and you're still paying these 5 bills, I need you to stop right now and listen very carefully. Because what I'm about to share with you is not opinion, it's not theory, and it's not some internet rumor that your nephew sent you on Facebook. This is breaking information that could directly impact your taxes, your retirement income, your social security checks, your savings, your bank accounts, and quite frankly, your entire financial future. The IRS knows about these exemptions. The government has quietly updated the rules. And yet millions of American seniors are still handing over their hard-earned money every single month for bills they are legally, completely, 100% exempt from paying. I'm talking about real money leaving your checking account, real deductions from your fixed income, real stress keeping you up at night wondering how you're going to make it through retirement, and all of it unnecessary. If you watch this video all the way to the end, I'm going to walk you through each of these 5 bills, explain exactly why you don't have to pay them, show you the specific IRS codes and government policies that protect you, and give you the exact steps you need to take starting today to keep that money where it belongs, in your pocket. Let's start with the first bill, and this one hits almost every senior I talk to: property taxes. Now, before you say, wait, I know about the homestead exemption, listen to me, because what I'm talking about goes way beyond the basic homestead exemption that saves you a few $100s a year. Did you know that in the majority of states across this country, there are specific property tax freeze programs, circuit breaker programs, and senior deferral options that can either freeze your property taxes at the rate they were when you turned 65, or in some cases, completely eliminate them based on your income level? The IRS doesn't collect property taxes directly, but here's what most people miss. The federal government has incentivized states to implement these programs through various housing and urban development grants. And the qualification requirements are much broader than you think. In states like Texas, the over 65 exemption can reduce your home's taxable value by $10,000 or more, and in some counties they stack additional local exemptions on top of that. In Illinois, the senior citizen homestead exemption automatically applies if you're 65 and own your home, but you have to apply for it. And here's where the common mistake happens. Thousands of seniors assume it happens automatically, and they keep overpaying for years. In Pennsylvania, the Property Tax Rent Rebate Program sends actual checks to seniors who paid property taxes or rent, and the income limits are surprisingly generous, up to $35,000 a year for homeowners and $15,000 for renters. And yet the State Treasury Department reports that hundreds of thousands of eligible seniors never apply. The deadline for many of these programs is December 31st of the tax year, but some states have rolling applications, and if you've been overpaying, you might be able to file amended claims going back several years. Now, the second bill is one that makes me genuinely angry when I see seniors still paying it, and that's certain types of federal income tax on your social security benefits. Here's the hidden fact that the IRS absolutely knows but doesn't advertise, depending on your combined income, which the IRS calculates as your adjusted gross income plus non-taxable interest plus half of your social security benefits. You may not owe a single penny in federal income tax on those benefits, and in many cases, you shouldn't be having taxes withheld from your monthly checks at all. The thresholds are $10,000 for single filers and $25,000 for joint filers before any of your social security becomes taxable. And even then, it's only taxed on a sliding scale that maxes out at 85% of your benefits for higher incomes. But here's the practical advice that could put money back in your pocket immediately. If you're having federal taxes withheld from your social security and your total income falls below these thresholds, you're essentially giving the government an interest-free loan every single month. You need to file Form W-4V with the Social Security Administration to stop or adjust those withholdings, and you can do this online or at your local office. Additionally, many seniors don't realize that certain deductions and credits specifically designed for retirees can reduce your taxable income below these thresholds, including the credit for the elderly and disabled, medical expense deductions that have been expanded for seniors, and charitable contributions from your IRA if you're over 70 and a half. The common mistake is assuming that because you worked your whole life and paid into the system, you automatically owe taxes on the benefits coming back out. But the law was written specifically to protect lower and middle-income retirees, And if you're living primarily on Social Security and a modest pension or savings, there is a very good chance you should not be paying federal income tax at all. The IRS updated its withholding estimator tool in recent years to be more senior-friendly, and I strongly encourage you to spend 10 minutes on the IRS website running your numbers, because the penalty for underwithholding is minimal compared to the money you could be keeping now. The third bill is where things get really interesting, and this is the one that involves banking regulations and fees that seniors are legally protected from. And I promised you that banks don't want you to know about this. Under the Electronic Fund Transfer Act and various Consumer Financial Protection Bureau regulations, seniors on fixed incomes, particularly those receiving Social Security, disability, or pension benefits through direct deposit, have specific protections against certain account fees, overdraft charges, and garnishment procedures that banks are required by federal law to honour. Yet they often don't unless you specifically invoke them. For example, if your Social Security check is direct deposited and a creditor attempts to garnish your account, federal law protects 2 months of those benefits from garnishment. But here's the catch. If that money has been sitting in your account for more than 2 months, or if it's commingled with other funds, the bank may allow the garnishment to proceed unless you file a claim of exemption immediately. Many seniors don't even know they received notice of the garnishment until the money is already gone. Beyond garnishment, numerous banks offer senior checking accounts with no monthly maintenance fees, no minimum balance requirements, and free checks. But they don't advertise them. You have to ask, and you have to know to ask for them by name. The qualification requirements vary by institution, but typically start at age 55 or 60. And some credit unions offer these accounts with additional perks like higher interest rates on savings. The actionable step here is to call your bank this week. Ask to speak with a branch manager, and specifically request information about senior account options, garnishment protection procedures, and fee waivers for fixed income customers. If they claim no such programs exist, mention the Electronic Fund Transfer Act and ask them to confirm their compliance policies in writing, because I guarantee you that will get their attention, and suddenly the options they didn't have 5 minutes ago will materialise. All right, let's talk about the fourth bill, and this is a big one. Unnecessary Medicare premiums and penalties. Most seniors know that Medicare Part A is usually premium-free if you or your spouse paid Medicare taxes while working. But what millions of retirees don't realise is that you may be overpaying for Medicare Part B, Part D, or Medicare Advantage plans because you haven't updated your income information with the Social Security Administration, or because you don't know about the Medicare savings programs that are federally funded but state-administered. The Income-Related Monthly Adjustment Amount, or IRMAA, is the surcharge that higher-income seniors pay on top of their standard Medicare premiums, and it's based on your tax return from 2 years prior. Here's the critical detail that creates urgency. If your income has dropped significantly since you retired, if you stopped working, if you lost a spouse, if you had a major life change, you can request a reconsideration of your IRMAA determination using Form SSA 44, and if approved, your premiums can be reduced retroactively to the time of the life-changing event. I've spoken with retirees who are paying over $400 a month for Part B because their IRMAA was based on a salary they no longer earn, and they had no idea they could appeal it. The Medicare savings programs, including the Qualified Medicare Beneficiary Program, pay your Part B premiums, deductibles, and coinsurance if your income and resources fall below certain limits. And these limits are much higher than most people assume. In some states, a single senior can have monthly income up to $1,300 and resources up to $7,500 and still qualify, while married couples have higher thresholds. The common mistake is thinking that if you have any savings at all, you don't qualify, but your primary home, one car, burial plots, and household items don't count toward those resource limits. Finally, the fifth bill, and this one ties everything together and could be the most financially significant of all. Unnecessary taxes on your retirement account, withdrawals, specifically related to required minimum distributions, or RMDs, and the rules that changed dramatically with the Secure Act, and subsequent IRS updates. If you're 73 or older, you know you have to take RMDs from your traditional IRA or 401k, and the penalty for missing an RMD is one of the harshest in the tax code, 50% of the amount you should have withdrawn. But here's what the IRS knows and what you need to know. There are multiple exceptions, exemptions, and strategic opportunities that most seniors never hear about. First, if you're still working past 73 and you don't own more than 5% of the company, you can delay RMDs from your current employer's 401k plan until you actually retire, not until you're 73. Second, the qualified charitable distribution rule allows you to donate up to $100,000 directly from your IRA to a qualified charity once you're 70 and a half, and that amount counts toward your RMD while being excluded from your taxable income, which is a double benefit that many tax preparers don't even mention to their clients. Third, and this is a recent update that creates real urgency, the IRS has updated its life expectancy tables for calculating RMDs, which means your required distribution amount may be lower than you think, but only if your financial institution is using the current tables, and many are still using outdated calculations. You need to verify this immediately because if you're taking out more than required, you're paying unnecessary taxes and depleting your retirement savings faster than the law requires. The actionable step is to contact your IRA custodian or 401k administrator. Ask them to confirm which life expectancy table they're using for your RMD calculations, and if it's not the most current IRS table, demand a recalculation. Additionally, if you inherited an IRA, the rules have changed significantly depending on whether the original owner died before or after 2020, and the 10-year distribution rule for most non-spouse beneficiaries has created a tax time bomb that requires careful planning to avoid massive tax bills in the final years of that window. You are legally exempt from overpaying on property taxes if you claim the senior exemptions available to you. You may not need to have federal taxes withheld from your Social Security, and you may not owe federal income tax at all if your income falls below the thresholds. You are protected from certain bank fees and garnishments under federal law, but you have to know your rights and demand them. You can reduce or eliminate Medicare premiums through IRMAA, appeals and Medicare savings programs, if your income qualifies. And you can optimize your retirement account withdrawals by ensuring your RMDs are calculated correctly and taking advantage of qualified charitable distributions and work-related delays. Each of these represents real money, your money that you've worked decades to earn, and there is no shame in claiming every legal exemption, credit, and protection that the law provides. The government has written these rules to help seniors maintain dignity and financial security in retirement. But they don't come looking for you to hand them out. You have to know about them, and you have to take action. I want you to feel empowered, not overwhelmed. Start with one of these 5 areas this week. Make one phone call, file one form, ask one question at your bank, and then move to the next. Your financial future depends on staying informed, staying proactive, and refusing to pay one penny more than the law requires. Please share this video with every senior and retiree you know, because not everyone has access to this information, and together we can make sure that our generation keeps every dollar they've rightfully earned. Stay informed, stay strong, and I'll see you in the next update.